Hey guys, welcome to What Are We Building Today? I am super excited to talk with you about how we finance ADUs. We haven't talked about this in a long time, and it's a good reminder to everybody as to what you need to be doing and what you need to be thinking about. A lot of people assume that ADUs are financed separately from the property, but in fact, they're financed as part of the real estate because they are part of the real estate. The term ADU stands for accessory dwelling unit, meaning accessory to the mother house or the mother, properties or whatever. So it's important to understand that. And today we're going to go through presentation I haven't done in a while, but that is just that much more critical to understand it. The ADUs, one of the two things, let me go back. There are two things you need to do before you get started on ADUs. The first one is feasibility. What can I build on my property? And the second is financing. What can I afford to build? And I say that, I'll say it again. That's because 75% of ADUs that get permits never actually get built. And that's because people will spend all this money on designs and permits and say, oh, I'll work on the loan later, only to find out that they don't qualify for the loan. And the number one challenge we have on these loans is your debt to income ratio. It's not credit score, it's not reserves and assets, it's do you have the ability to repay? And that is based predominantly on your debt to income ratio, meaning your monthly debt payments, including this new loan, can't be more than your monthly income. So let's go through. First of all, I want to talk about tiny homes versus ADUs. A tiny home and an ADU can look exactly the same. It can be literally the same unit. Some units are actually interchangeable, and that's wonderful. I see them really as low as 100,000, but the quality ones are about 150,000. But what's interesting is that tiny homes are not financed as part of the real estate. They are financed as secured to the unit, kind of like an RV. So I want you, just like RV loans and car loans, the term of the loan is like 8 to 15 years and maybe 20 at best, compared to a real estate loan, which is 30 years. So the monthly payments are double and even triple. Additionally, the rates are much, much higher. Why? Because the asset can be driven away. Also, and therefore stealable. The other thing about tiny homes is when you drive them off the lot, when you drive a car off the lot, does the car appreciate or depreciate? Well, we know that RVs depreciate just by driving them off the lot brand new, depreciate $30,000. So if you were to turn around and sell that RV the next day, you would not be getting the same price that you paid for it. Same thing is true with unattached mobile homes, which are in mobile home parks, and also tiny homes on wheels. That same unit, when you attach it to a permanent foundation, is we call it permanently affixed, that ADU becomes another type of housing unit. And as you know, housing, generally speaking, always appreciates over time. It is the cheapest rates on the face of the planet. And so, as you can see, and a tiny home that costs almost 50% of an ADU has a higher monthly payment because the rates are higher, the terms are smaller. It's just not, banks just don't like those loans. So that's why it's important that the ADUs be considered part of the real estate. There's a number of reasons why you want to get pre-approved on the loan first. We talked about the importance of knowing what you can build. But you need to understand that the mortgage guidelines significantly differ than the real estate guidelines. And even with my construction and renovation loans, which we specialize in, I can't always build 100% of the cost of construction. I am limited by appraisals, which are often lower. And so we need to look at that strategically. Also, part of my goal is to demonstrate the optimal return on investment. A lot of people think that to maximize the rental income on a property, you got to build a great big 3-bedroom house. And what you're going to find is actually that optimizes the number of kids running around in your backyard, beating up your brand new house. If you're renting it, we often find that 3 1-bedrooms is the optimal rental income. But if you're going to sell it off, and yes, that is a new thing, that building the 3-bedroom is the optimal, but it all depends on your particular neighborhood. So, um, what you need to know is that the state of California now drives these rules, not so much the local permit offices. So they created statewide guidelines that allow for up to 4 total units on a property. And this is a variety of constructs. It can be an internal conversion in the primary house, meaning you take a great big house and split it in two, plus an attached junior ADU and a detached ADU, or you can do a primary house, an SB9 unit, which is a true second house, and so on and so forth. But 4 units is generally what you're seeing. In practice, yes, people build the back units, but oftentimes they will split up an internal and do an internal conversion, as we call them. So, for example, if this is, a formal living room and dining room, the kind you only use at Christmas and high holidays, that can be turned into a great little 2-bedroom unit, just split off from the house. And then this would be a junior ADU and a detached ADU. So every property is a little bit different on how you want to optimize your return on investment. Now, mortgage guidelines are very different. They currently only allow one ADU, but as of April 1, 2026, they will allow multiple ADUs up to 4 units, but only for Fannie Mae, not Freddie Mac, not FHA. Right. FHA, VA only allowed for attached ADUs, not detached. Okay. And then we cannot factor in, unless the appraiser says so, the gross living area, the ADU square footage into the overall gross living area, which is why you sometimes see ADUs appraised at a $0 value. Dumb as bricks, but yeah, I see it happen all the time. We're the only bank I'm aware of that has trained appraisers that give a full value on our ADUs. They have to look at they can now look at duplexes, they can now look at single family houses plus an ADU, but they do have to have comparable sales. They also have to do now a rental income, a market assessment on that. And so the income approach to the appraisal and of course the construction cost approach. I usually see the cost of construction is what we end up with because there's a lot of confusion in the marketplace. Now, what does an ADU cost? I am the largest ADU lender in the state. I see bids across my desk all day long. And I just need to tell you, they are all the same. It is the cost of labor and the cost of construction plus about a 15% GC markup. So you shouldn't see too many variations, maybe within 15,000. The attached ADUs are typically 100,000 to 120,000. I'm seeing a little higher on the 120,000 side. The detached ADUs in lower cost areas like Southern California are about 175,000. In the Bay Area, and high cost areas like Seattle, we often see 300,000. And that's because your cost of labor and your cost of materials are much higher. Now, why is there a cost difference? Well, you can see this with your own property. This is a perfect L-shaped house that is perfect for a junior ADU. And I know it's a lower cost because you can look, there's 2 things happening here. One, the foundations and the footings appear to be the same as the primary house. So you're not having to redo those foundations and footings. Also, the rooftop has been trussed the same and maintained the same. So really you're just gutting the inside of the garage. Now, pro tip, you're not going to put a door right here, right? Because then it's really awkward running into your tenants every day in the morning and evening. Smart ADU professionals will put the door here, or even better, facing over here with maybe a little front entry garden. That's going to create the privacy that you're going to enjoy, your tenant's going to enjoy, and you can command higher rental income. Super important. Now, compare this to a detached ADU, and this is pretty classic. I can tell right now that this is maybe a 4-inch foundation with no footings on the side and no reinforced rebar, which is probably why there's lots of cracks in that footing. So these, right off the bat, I can tell you the foundation either needs to be fully reinforced with footings added, which costs about $20,000, or and by the way, it needs to have a lip around the side typically to keep water, above the drywall and stuff. Or it's got to be totally demoed, also worth about $20,000. So either way. Now, and you can look, the roof and the roof trussing, that's not a housing code trussing thing. So probably normally I would say this is going to be totally turned down, demolished and rebuilt. Except that I picked this picture for a very good reason. Notice how this is up against the side fence here, which means it's probably against the property line. So this would probably be mostly torn down except that wall, because if you remove the wall, you have to move the whole thing into current modern setbacks, which is 4 foot. But if you keep a portion of it, you can maintain grandfather in the current setbacks and keep it where it's at. That's a big difference, and another important reason why you want to work with ADU pros. I actually have seen an incident where the homeowner hired a new home builder. They didn't realize, they ignored the architect's explicit directions not to tear down that sidewall. They did. The city came out, inspected it, and said, guess what? You've got to redo everything and move everything in by 4 feet, which costs them 6 months and considerable extra money. So important reason why you want to work with an ADU professional and not just a regular home builder, and certainly not, your standard kitchen remodeler. They just need, these are special rules and they need to know what's going on. Now, we've broken down the cost on this, but what is that monthly payment? Because you're like, oh my gosh, it's so expensive. Let's look at these costs. At today's cost, we're actually at about $600 per month, $500 to $600 per month per 100,000. And this ADU is probably going to rent for $2,000 minimum, probably in LA, San Diego. It'll probably rent for 2,500 in the peninsula and the Bay Area. It rent for like 4,000 bucks a month. So yeah, interest rates are a little higher, but the rents are way worse. I have never seen an ADU not cash flow by like 200%. It's unbelievable. So take a look at the return on investment before you freak out about the interest rates, because they're a lot better and it's worth every bit. Now, how do you know what is your rental income is going to be? Well, I like to don't look at the aggregate of the metro area and average costs. Your rental income depends on right in your neighborhood. So I like to go on Zillow and I look up the property, your personal property right on Zillow, and take a look at the estimate and all that kind of stuff. And then I look right in the streets, right in your neighborhood. And if the ADU looks like a house, then have it look at for rent and have it deselect apartments and townhomes. And you will find that you're going to find ADUs. And ADUs, you can charge much more for an apartment because it feels like a nice private single family home. Whereas an apartment, you can kind of hear everything your neighbors are doing. It's not as much, not worth as much. So we look right in your neighborhood. We select for rent and for houses only if it looks like a house. If it looks like an apartment, then fine, look at apartments. And then we're going to compare one bedrooms, two bedrooms, and three bedrooms if you're going to rent. Now, in this example, in North Park, which is a very nice neighborhood, very well desired, the one bedrooms go for about 3,000 a month. And you can see the sizes and so on about, what they're going for. In this example, this is a smaller ADU, and to be honest, it's not very nice looking. Like pictures really matter here. So you can take a look down and see what else they're going for, etc. Now, this guy is renting for 1900. He probably didn't get the memo, or it's not a very nice place. But you've got other comps, comparable rents for 3,000, 2,800, et cetera, 3,000 up here, et cetera. But down here, you've got another ADU for 1,300. Well, I hate to say it, but Encanto is not a particularly nice neighborhood. So it's very different neighborhoods, and that's why you don't want to look at the metro average. Now, the opposite is true. I happen to look these up for sale. So if you're going to rent it, it would be optimal here to build, and you have space for a three-bedroom unit, it would be optimal to build three one-bedrooms at 3,000 apiece because you'd be getting $9,000 in income for a construction cost of probably 300,000 to 350,000. For the same construction price, you could build a three-bedroom unit and that you could sell that off for probably 2.5 million in that North Park area. Maybe a little less in this day and age. Whereas the condos are only selling for about $600 a piece. So if you built the three one bedrooms and went to sell them off, you could only sell them off for 600 a piece, which is only 1.8 million. So this is where you need to compare your optimal situation for rent versus sell and then make your decision on designs and not before, because otherwise you're just guessing. Now, how do we pay for this all? I want you to imagine, a lot of people think my loan is forever. It's totally not. A loan is just a tool. And by the way, once we do a loan on a property, any future refinances on that property of the first or second mortgage, like HELOCs and stuff, we waive our lender fees. So I want you to think of what the loan you have for a construction loan as a temporary loan. The purpose of a construction loan is to finance 100% of the cost, but with a reasonable cash flow. I generally don't want you paying on the full loan amount while you're waiting for some guy to stamp permits. That's a waste of your time and money. When you're done, that's when you get the classic low interest rate permanent loan where you're paying all of the money because now you got the rental income and you can pay it off. So, what the heck am I talking about? Well, most people on an owner occupied home, meaning you live there, they're not doing a cash out refinance. What we're doing is a lot of HELOCs, home equity line of credit. That is a type of second mortgage. It is not separate from the house, hence the term home equity loan or line of credit. And we can go up to 90% of appraised value. And we typically do interest only payments. So HELOCs are kind of like a credit card. They're great tools, except they're secured to your mortgage. So they're as low as 6% right now. So not the 32% of credit cards. So if I get you a HELOC, you get a checkbook instead of an actual card to spend the money. Let's say first month you spend no money, then you get a bill for zero. Just like a credit card, if you spend no money, you get a bill for zero. If you drop a check for $10,000 to start work on designs and permits, you get a bill for about $70. That's it. And as you spend money on that HELOC, you only pay on what you use. It's a great loan. When we're done, we typically convert that into a fixed rate second mortgage, which is a lower rate, typically at 5.8% or 6%, something much lower than the HELOC. The HELOCs are typically a slightly higher rate. Now, we do have construction and renovation loans that are based on future value. And so those are really important. Now, what do I mean by that? Well, if you recently purchased or you don't have quite enough equity, renovation and construction loans are great because they're based on future value. Quite literally, I send the appraiser out with the pretty architectural designs and the floor plans, and he says, "Oh, I see what you're going to build. When you are done, your property is going to be worth more." And the more number is what we base the loan on, not the current value. So let's say, for example, this house has a current value of $700,000 and you go to do a HELOC with your local credit union. They only go to 80% loan to value, combined loan to value. That doesn't really get us the cash available to build really what we want. But even if we got a low ball appraisal on that future value, and we talked about that, sometimes we get those, we still, because we're basing it on future value, we can get up to 110% of that future value. In this case, 90% of future value, and that gives us the money to build what we want. On rental properties, we have very similar types of loans. We do HELOCs for rental properties. We also do a lot of construction bridge loans. These are the loans my professional fix and flippers use to fix and flip, to build ground up, which is more of what they're doing these days. It is a temporary loan and you refinance out of it as soon as you're done with construction because it's a higher interest rate. Now, let's say that you have tons of equity and you're retired and on a fixed income or close to it. That's okay. We've got lines of credit. These are offered by the Federal Housing Administration. They're government backed. We've got a bunch of options we can treat for that. Yes, they are a reverse, but again, we use them as a temporary loan. If you take a look at the math, that's where you make the decision. The great part is math doesn't lie. It either makes sense and pencils out or it doesn't. But you need to have all the options. We also have bank statement HELOCs, DSCR HELOCs, no income HELOCs. We've got all kinds of loans, more than 400 actually, to accommodate almost any borrower. So that's the kind of creative financing based on different ways of calculating income that can make sense. So all of construction, what's unique in construction, and this is very collaborative and simultaneous. We don't ever push you to do a loan because you're not ready until you're ready. I mean, there's a lot of working parts here, but here's a general timeline. I don't care what the contractors say. Typically, you do loan pre-approval first. If there are ADU grants available, and we're happy to help with that, we're very involved. We get that done upfront, and then you start designs. Designs typically take about 20 to 30,000, depending on your degree of difficulty, and 2 to 3 months. It can be shortened and cheapened if you use pre-approved designs. But honestly, you're going to have this property for a long time. Don't your designs is really where you want to invest good money, not go cheap. Because your designs are where you save thousands and thousands of dollars on your construction. Trust me on that. Your permits are typically 4 to 6 to 9 months, depending on location. The cities and municipalities are getting better about that. Those typically cost about 10,000 unless you have a higher degree of difficulty. Now, I keep saying degree of difficulty. What do I mean by that? I mean, like if you have a second story that requires some structural engineering, costs a little bit more. Absolutely worth it. The rent's more than pay for it. If you've got a hillside, you may need to do some work on that, reinforcement, whatever. Going to be a little higher degree of difficulty. Uh, Soils, there's something called liquefaction, which means if you're in an earthquake, the sand liquefies, and sometimes they've got to be tested, worth every penny, right? And then finally, your construction is where you spend 90% of your money. So my recommendation is get pre-approved. Even if you pay cash for designs and permits and do the renovation loan or whatever here, that is a very acceptable offer, and that's what I mean by collaborating. I don't want you paying on loan unless you have to. Alternatively, you start a HELOC, and your HELOC can pay for all of this all the way through. And when you're done, we either refinance it or sell it off and pay off the loan. So lots of good options. While you're at it, it's you got guys stomping through your yard. Let's get all the projects on your property done. If you have a roof that's probably needs to be repaired or will when you're retiring, get it done now. Get a 50-year roof so you don't have to worry about it when you're in retirement. My recommendation is add solar. I have one retiree who added solar, increased the cost of rent to include utilities by $200 a month, and then went out and bought an electric vehicle. And he likes to joke that his renter is paying for all his utilities and his gas too. He thinks that's very funny. ADUs for family. You can read the slide, but I want you to imagine that mom and dad own this property and Junior wants to add an ADU, but his sisters don't want him taking over the inheritance of the house. It's okay. We have a couple ways to skin this cat, and that is to, in the trust, you clarify that mom and dad own the house and the land, and Junior owns the ADU and is responsible for that payment. Or you do it as title it as joint tenants in the same way. Either way, this allows Junior to take on a type of second mortgage, usually a HELOC to start, and then a fixed rate second mortgage. And he is responsible for that mortgage and only owns his ADU. When mom and dad pass away, they can bequeath the house and their land as they see fit. But Junior still owns the ADU, so they've got to figure it out. My recommendation is if you're building for a young family member, go big. Go big. Always think 20 years in advance. He might be in college right now, but you're going to blink and he's going to be engaged and getting married. My answer to that is, what are you going to do at that point? How many grandkids do you want? Because you got to think one room per grandkid typically, right? So maybe at that point you move into the ADU and he moves into the primary house. Or in my case, I'm building two ADUs, one for each of my kids, or a two-bedroom for me ADU, or sort of junior ADU, and then an ADU for one of my kids, and then the other kid takes over the front house. So that's the kind of thing where I get to live with my kids and ultimately my grandkids, and take care of them while they take care of me as I age in place. That is a long-term strategic plan for multiple generations above. Property taxes. Property taxes are not reassessed in California. That's a big issue with Prop 13. The ADU is actually the cost of the ADU is tacked on to and assessed at the current rate. I usually see for a small ADU, I usually see about $100. You can call the tax assessor and ask, and there's also ways to fight a bad reassessment. So that's something you might want to talk with them in advance. It also depends on what the contractor submits. When they submit for permits, they're required to estimate what it's going to cost. So you want to be strategic, shall we say, in that estimate. Homeowners insurance should not also double. It should only cost about $20 a month extra. Again, the homeowners insurance covers the entire parcel. The ADU should not be separate. If your insurance agent is asking it to be separate and have a whole new policy, I can get you a better insurance agent. The only time your ADU would have a different insurance policy is if it's sold off as a condo. California has had grants and they are available right now locally. The ADU grant from CalHFA is currently not available, but we'll keep you posted on that. That's part of our service to you. My big warning is be the black hole of lending is a half-built construction projects. Banks don't like it because they don't know what's happened. They don't know if it's been built to code. And if that happens, and you need more money from your house, we're looking at a refinance of your primary mortgage at double-digit interest rates. Nobody wants to do that, trust me, especially not the bank. The number one way this happens is when my clients go for the lowball bids. They go cheap. Like I said, construction budgets are typically the same. These guys aren't getting magic sources of free labor and they're all going to the same places for materials. So it's not like, they're getting some massive discount somehow. Um, but typically, if you're seeing a bid that is 15 or thousand or more lower than your other bids, beware, because that's somebody who really doesn't know what they're building, or they are deliberately lowballing your bid in order to get your business. But either way, they're going to come back to you mid-construction and say, "I'm sorry, I didn't include this in the contract. Pay up an extra 25,000, 50,000." And at that point, you're stuck in that refinance unless you have the cash on the side. And that makes me crazy. I just saw that happen. One way to prevent that is I went through my client and we did a web search on that contractor. We looked up their reviews. Sure enough, even though they were licensed as a general contractor, they had 37 reviews on Yelp at a rating of 3.1 stars out of 5 stars, and only for septic. This is a septic contractor. He's never built structural engineering projects. He's never done electrical work, etc. That's why his bid was $120,000 lower than the other bids coming in. So I'm hoping that I saved them heartaches, but they're definitely not going to work with him. That's quite scary. And finally, know your numbers. This won't make sense to you now because every person is different. But these are the types of pro formas that real estate investors do and that I do for my clients. And numbers don't lie. So the math either works or it doesn't, and you need to be able to compare those. You can get your own pro forma and discussion simply by booking a calendar event with us. And we can talk through those numbers before you do any loan applications, et cetera. And we can work through to make sure you're optimizing your return on investment on your ADUs, whether you're building them for rent or for family or on an investment property and expanding your investments. So that's all I have to say today. I think it was worth a good review of how ADUs are built. This is very similar to how room additions are built. If you're on a primary home on an R1 property and you want to build 3 extra units to make it a fourplex, same deal. There's a lot of loan options for you. And of course, if you're building on an empty lot, that's a new construction loan, and we specialize in those as well. So if you have any questions, schedule time with us and we'll talk it through. Thanks.